Good morning, everyone. My name is Kasey Almanzi, and I am a Tax Supervisor with Bowers & Company CPAs located in Syracuse, New York. Today, we will be covering all things Nexus. What is Nexus? Nexus is a relationship or connection between two or more entities. However, in tax law, it is a relationship between a taxing authority, such as a state or a business. Nexus must exist before a taxing authority can impose a tax on an enterprise, and it is required a substantial link between a jurisdiction and the business. So what are the different types of nexus? There's income tax nexus and sales tax nexus. So just to understand how this is applicable to you, every time you get in your truck, load it up, and drive through, say, Virginia, you could potentially create nexus. Now, there are so many other factors that you have to think about, but that should be on your radar. Every time you're going through a state, there could often trigger a filing requirement, and if you don't meet this filing requirement, you could incur interest, penalties, and a very large headache. So, income tax nexus. A business can trigger income tax nexus by meeting any of the criteria below, subject to certain thresholds. It earns revenues from sources within the state, owns or leases property in the state, has employees engaged in business activities, or has capital assets or property located there. The other type of nexus is sales tax nexus, and we won't spend much time on this because it's not as applicable to the transportation industry, but it's still something that should be on every company's radar. Sales tax nexus can occur if a business meets any of the following criteria subject to certain thresholds. A physical location in the state, resident employees working in the state, it has property, including tangible property within the state, or it has employees who regularly solicit business there, such as salespeople. It is important to note that a business may have one or both of these types of nexus. However, having one does not automatically trigger the other. So let's explore the impact of the Internet. Prior to the creation of the Internet, Nexus was fairly easy to track, as companies often shipped brick-to-mortar stores such as a Macy's, JCPenney, or AutoZone in a few areas. However, now in the age of the Internet and the rise of Internet shopping, companies can sell easily to people in all 50 states. As a result of this, companies often do not realize when they hit their Nexus thresholds in certain states and can face failure to file penalties that can grow to an exorbitant amount. So let's explore the most pivotal case in the Nexus space, which is South Dakota versus Wayfair. This case changed Nexus as we know it in the business world. The Supreme Court case from 2018 ruled that states can mandate businesses without a physical presence in a state with more than 200 transactions or $100,000 in state sales to collect and remit sales taxes on transactions in the state. So what does this mean for companies going forward? It means that it is important to not only track the physical transportation of goods, but online sales that might be completed through third-party carriers to certain states. So how does Nexus apply to the transportation industry? Nexus in the transportation industry is especially complex because most carriers don't sell goods and services in individual states. They instead are delivering someone else's product. Due to the rise of Internet Goliaths such as Amazon, many states are changing their laws around Nexus, such as having Nexus created simply by a company picking up or delivering goods in a state. Nexus may also be triggered in many states simply by driving through. Two ways states are identifying carrier presence in states are through weight stations and enforcement stops, as well as audits of international fuel tax agreement filings. Often a state will send a business questionnaire to a carrier if a truck is stopped in at a weight station or enforcement stop to determine if they have Nexus, or they will review the International Fuel Tax Agreement report to see the physical presence the carriers have in the state. So how do you determine if you have Nexus? In determining if you have Nexus, it is important to not only look at the common routes of your carriers, but also to track the states you are delivering to, as well as the amount of revenue you derive from these states. Small amounts will often not be enough to trigger Nexus. However, once you get to higher thresholds, it's important to take notes of these states. So how do you mitigate the risk? The two most important factors to staying on top of Nexus and required tax filings is by keeping good records and having a trusted advisor for consultation. If you are unaware of your company having Nexus, it can be costly. Recently, we had a client that had their international fuel tax agreement reports audited and consequently had to file 10 years of amended tax returns. Not only does this cost you tax and penalties, but professional fees as well. It is important to note that states also do offer self-reporting and various other plans that will help businesses become compliant and be a less expensive option, but it's always good to recognize your filing requirements with Nexus prior to it getting to this point. By tracking and understanding where your carriers are driving through and delivering or picking up products, as well as having a well-versed Nexus advisor, will help avoid penalties, audits, and headaches down the road. So if you have Nexus, what are the next steps? Once you determine you have Nexus, your next step should be to contact your tax professional. To ensure your company is compliant, tax returns will need to be filed. However, you may receive a New York credit to mitigate that tax. Thank you for joining the webinar, and if you have any questions, please feel free to contact me.